This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So to finish off the F1 aspect of group accounts, we're going to go through now and look at associates. We looked previously, didn't we, at consolidation with regard to a subsidiary. We consolidated the subsidiary provided that we had control, which in exam questions was having greater than 50% ownership of the equity share capital. However, we may not own greater than 50%. Maybe we own less than 50%. And if that's the case, if we own somewhere between 20 and 50% of the shares within an entity, then what we can assume there is that we have significant influence, okay? Because without having 50%, you can't pass an ordinary resolution, can you? So therefore you cannot appoint the directors. However, if you own 20, 25, 30, 35, 40, 45%, whatever it may be, you still have a bit of an authority, don't you? Okay, you can't tell them what to do, but you can be like a bit of an irritant, can't you? There could be a board meeting, or there could be an AGM. I suppose more likely an AGM, isn't it, with your share ownership? And what happens at the AGM, you can stand up and you can start talking. You can put your hand up and you can tell them about what you think that should be happening. So you have a little bit of influence on people's decision. You can't direct them because you don't have, if you like, enough votes to be able to pass an ordinary resolution. Okay, but you can be a bit of an irritant. Okay, so if you like, what we're saying there is that with 20 to 50%. You have not the power to direct, but the power to participate. Okay, i.e. you can go through there and be a bit of an irritant. You can make yourself heard if you so like. So what are we going to do about that investment? Okay, we've bought the shares, we've paid an amount to get between 20 and 50%. We're not going to consolidate it because we don't have control. But it's not just a very simple investment whereby we just get dividend income, is it? We need to show that influence. And to show that influence, what we do is we look at a process that's referred to as equity accounting. And equity accounting, quite simply, is accounting for everything based upon P share. What does the parent own? Okay, and we'll account for everything in that basis. We don't look at things on a line by line basis. We just look at things in one line item on the SFP and one line item in profit or loss. Okay, based upon this equity principle, i.e. the percentage ownership. So if we look at the first bit, the group statement of financial position, what you have there is referred to as an investment in associate. The investment in associate is one line item as a non-current asset. Okay, and what you do is you take the cost of the investment, so essentially to you and I, that's what you've paid. So that's what you see in the individual parent accounts before you equity account for the investment. And all we do there is we just add on our share of A's post-acquisition reserves, and then we deduct any impairment that there may be. Okay, so maybe there's been bad news about the associate that we have. Therefore, we decided to reduce the value of it for whatever reason that may be. Okay, so it's key, therefore, that you learn that pro forma. It's the cost of the investment plus your share of whatever A has generated since the date of acquisition, and then you reduce that value by any potential impairment. Okay, there's a nice simple example just below which pulls it together. So what have we got? It says calculate the investment in associate to appear in Penny's financial statements, so the parent's financial statements on the 31st of December X5. Okay. So what have we got? It says Penny bought 30% of the equity share capital, so therefore Alex is an associate, isn't it? We're going to go through there and equity account. We bought it on the 1st of January, so that is the start of the year, and we paid, is it $250,000. The profits for the year were 170,000. So We've only been trading for 1 year since that acquisition date. So the parent will own, is it 30% of those post-acquisition profits? Tapping 30% of 170, does that give you 51,000? Okay, we've only had the associate for 1 year, so therefore we just need the profits for the year. Just be careful, exam questions might complicate that. To go through there potentially and work out, is it those post-acquisition reserves? You may need to calculate that. Again, looking at, is it your retained earnings at year end, and deduct your retained earnings at acquisition. So obviously if you've had the associate for several years, you might need to work out the post-acquisition retained earnings. Okay. Here we bought the subsidiary at the start of the year, and as we bought it at the start of the year, we just need to look at the profits for the year, don't we? Because they are the post-acquisition profits. Take our 30% share and away we go. It says an impairment was carried out at the end of the year and the investment was found to be impaired by 20,000. This is the bit that you do need to be careful of, because when you're looking at the impairment has already been calculated for you, and that already takes account of your percentage ownership. So you do not need to take 30% of the 20,000. Okay, it's saying the investment in Alex, so your investment in Alex, your 30% ownership is impaired by 20,000. Okay, so do not prorate it, or take 30% of it if you so wish. Tapping those numbers into your calculator gives you a figure of 281,000. That's the investment in associates. That's the figure that appears on the SFP as a non-current asset, isn't it? Okay. Don't start prorating or taking 30% of all the assets or the liabilities on a line-by-line basis. No. We only put things in on a line-by-line basis if we have control, and then we put in 100% of that asset and 100% of that liability. Okay. For the investment in associate is just an equity accounting exercise, one line item. Okay, based on that calculation there. Other bits as well, just to go through and concern yourselves with, is if we've added our share of the profits to the asset and deducted the impairment, we will also need to include those figures in your group retained earnings on the SFP, which is there, is it as working 5. Okay, there we go. Okay, so you need to add in 51, take out 20 from the group retained earnings, because if you don't, you've adjusted the asset at the top but not made an adjustment elsewhere, and if you don't make that adjustment, then it doesn't balance, does it, your statement of financial position. Okay, so there we have it. Exam questions would be as simple as that. It wouldn't get too much more difficult than what you see there. In terms of the group statement of profit or loss, what you go through and do there is you put in, again, one line item that you equity account for as your share of profit of associates. Where do we show that? That is shown immediately before profits before tax. So it's part of all of the, if you like, the investing activities aspect, isn't it? Okay, you've invested in the associate, you will receive dividend income, etc. And that dividend income goes into investment income, doesn't it? So therefore, the share of profit of associate goes within that section, so effectively immediately before PBT. And to work it out, it's very, very, very straightforward. Again, you just take your share of A's profit for the year. Again, just be careful. You need to go through there and prorate, don't we, that profit if it is a mid-year acquisition. Okay. And then from that figure, you deduct the impairments, but the impairment in the year, not a cumulative effect. On the SFP, everything is cumulative, isn't it? In profit or loss, it's just for that year. So based upon our numbers before, I think, did we take, was it 30% of 170? So that was our ownership at 30%. A's profits for the year were 170. The impairment was there, was it at 20,000? So there will be one line item in profit or loss that says share of profit of associates at $31,000. Okay, that's it. Again, with the impairment, first of all, make sure that it's the impairment for the calendar year. And secondly, don't take the 30% share of it. The impairment is already given to you based upon your percentage holding. Okay. Other bits and pieces just at the bottom. I think, again, it's that magic stuff that you need to go through there and learn. Because we've said that if you own greater than 20 but less than 50% of the equity share capital, then that shows significant influence. Then that means that you equity account. There are, if you like, evidence or ways in which significant influence can arise. So imagine you had 19.9%. Okay, it's not 20, is it? So you think, right, I'm not going to go through there and equity account for it because we don't have influence and we're not an associate. Depend upon some of the specifics, because what you've got, if you have representation on the board, we spoke about the AGM, didn't we, and be able to cast your votes and be able to participate. But if you've actually got representation on the board, maybe your percentage ownership is significant enough to get representation on the board, then you have the power to participate, don't you? You've got a director in that boardroom. They can give the ideas, they can influence what's going on, but they cannot control, because there are more directors than what you actually have. Okay, maybe you have 1 out of 3 or 1 out of 4, I don't know, 2 out of 5. And that might go through there and help you influence the decisions. If you can participate in the policy making decisions, which presumably you could if you have representation on the board, then again, that goes through there and dictates that there is influence. Material transactions, if there's big transactions taking place between yourself and the business that you have an ownership in, even though it's 19.9%, it sounds like you have influence because the volume and the size of the transactions is significant, and it would only be significant, presumably, if you had influence. Likewise, maybe if there is an interchange of managerial personnel, so you have supplied some of the management to that associated company, and therefore if your management is involved, they must be able to have influence, mustn't it? And also as well, maybe you've helped them out, technical maintenance, whatever that technical maintenance may be. It could be there helping repair planes and providing maintenance to a plane manufacturing company. It could be maintenance in terms of the IT systems, anything to do with technical maintenance or improving or keeping things going as they currently operate. Again, the reason why you are there is because you have had influence over that entity to be able to help them with the technical issues that they have. Okay, again, by addressing those technical issues, you have influence, don't we? Okay, so if you learn those, again, I think it could be a drag and drop, and it could try and confuse you, couldn't it, between the criteria for control and the criteria for having influence. Okay, and it might give you a mix of them, and it might say drag and drop, which of the following demonstrate influence, or drag and drop, which of the following demonstrate control. Okay, if you can do that, it should be a pretty straightforward question, provided that you have learned the criteria. Shouldn't take too long, so take a little bit of time away from me, away from the videos, away from friends, away from family. Get yourself locked up into a room, turn the light on, and just read, revise, and ensure that you learn the criteria. If you do that, you're going to get yourself a nice, easy question somewhere within the exam. Other than that, that's it. Group's done, dusted, finished, finito, complete. If you've got any questions, you know where we are. Practice the questions time and time and time again, and you'll find that this area of the syllabus is very useful to help you score some high marks.